Hello there, it's that time of year again, tax season. Today, we're going to talk about how to avoid the headache, navigating common tax return mistakes and their solutions. Now, we all know that taxes can be quite a pickle, and making mistakes on your tax return, that's a pickle you definitely don't want to find yourself in. These errors can lead to all sorts of complications, from delayed refunds to potential audits, and they can be quite a hassle to correct. So, it's best to avoid them from the get-go. In this video, we'll walk you through some of the most common tax return mistakes, such as inaccurate income reporting, not maximizing deductions, choosing the incorrect filing status, and misunderstanding the timeline. But we won't stop there. We'll also provide you with practical solutions to help you navigate these issues with ease. So, buckle up and prepare to become a more informed taxpayer. Stick around as we dive into these common mistakes and provide you with practical solutions. Also, if you're looking to purchase a home in the future and don't know where to start, be sure to check out our first-time homebuyers guide video. First up, one of the most common mistakes: inaccurate income reporting. It's a significant aspect of your tax return that needs meticulous attention. It's not just about jotting down numbers. It's about presenting a transparent and honest financial picture to the tax authorities. Let's delve into why it's so crucial. Accurate income reporting helps determine the correct amount of tax you owe. Underreporting or overreporting income can lead to discrepancies and could land you in hot water with the tax authorities. Not to mention, it could result in penalties or even an audit. Underreporting income, intentionally or otherwise, is a serious offense. It's seen as a form of tax evasion, which is illegal. On the other hand, overreporting income might increase your tax liability unnecessarily. It's not about paying more or less tax, it's about paying the right amount of tax. So, how can you ensure accurate income reporting? It starts with good record keeping. Keep track of all your income sources, including your salary, freelance work, investments, and any other income. Make sure to include everything, even the small amounts that may seem insignificant. Use organized systems to keep your financial records in order. Digital tools and apps can be a great help. They can track your income and expenses, making it easier to report accurately. Next, understand the different types of income. Not all income is taxed the same. For instance, earned income is taxed differently than unearned income, such as dividends or interest. Understanding these differences can help you report accurately. Lastly, don't hesitate to seek professional help if needed. Tax professionals can provide valuable guidance and ensure your income is reported correctly. Remember, accurate income reporting is essential for a trouble-free tax season. Next, we're going to talk about how to maximize your deductions. This is a key part of navigating the tax season successfully and ensuring you're not paying more than you need to. Let's start with the common deductions that taxpayers often overlook. One of these is the student loan interest deduction. If you've been making payments on your student loans, you can deduct the amount of interest you've paid over the tax year, up to a certain limit. This can be a significant boost to your tax return, especially if you're in the early years of your loan repayment where the interest is the highest. Another often overlooked deduction is for charitable donations. If you've made donations to a registered charity, you can deduct these from your taxable income. Remember, this isn't limited to just cash donations. If you've donated goods or even your time, you may be able to claim a deduction. Home office expenses are another area where you can maximize your deductions. If you've been working from home, you may be able to deduct a portion of your housing costs, such as rent or mortgage interest, utilities, and even internet costs. The key here is that the space must be used exclusively for your work. Now, you may be wondering how to claim these deductions. The process is fairly straightforward. You'll need to itemize your deductions on your tax return, rather than taking the standard deduction. This means keeping track of your expenses throughout the year, and keeping any relevant receipts or documentation. It may seem like a bit of work, but the impact on your tax return can be substantial. Remember, every dollar you can deduct from your taxable income is a dollar you're not paying tax on. So take the time to understand your potential deductions and make the most of them. You might be surprised at how much you can save. Never underestimate the power of deductions when it comes to your tax return. Now that we've explored maximizing deductions, let's delve into another crucial aspect of your tax return: tax credits. Unlike deductions, which reduce the amount of your income that's subject to tax, tax credits directly decrease your tax bill dollar for dollar. They're essentially a gift from the government, so it's important to take advantage of all the tax credits you qualify for. Firstly, there's the Earned Income Tax Credit, or EITC. This is a refundable tax credit for low to moderate income working individuals and couples, particularly those with children. The amount of EITC benefit you receive depends on your income and the number of children you have. Next, we have the child tax credit, which is also refundable for some taxpayers. It's designed to offset the cost of raising children. In the tax year 2021, the credit was expanded, and more families are now eligible to claim it. Then there's the American Opportunity Credit and the Lifetime Learning Credit, both of which can help offset the costs of higher education. If you, your spouse, or your dependent is a student, you might qualify for one of these credits. Finally, don't forget about energy tax credits. If you've made energy-efficient improvements to your home, or you've installed renewable energy sources like solar panels, you may be eligible for a tax credit. Just like with deductions, you'll need to keep track of your expenses and maintain proper documentation to claim these credits. So, make sure to explore all potential tax credits available to you and reduce your tax bill as much as possible. Before we move on to our next topic, don't forget to check out our resources on personal and business finance at www.farmercapital.net. We have a wealth of information to help you navigate your financial journey. Now, let's move on to another common mistake: choosing the wrong filing status. Often taxpayers might be tempted to rush through their tax returns, and in the process, they may overlook the importance of selecting the correct filing status. The filing status you choose directly impacts the tax benefits you may qualify for and ultimately, the amount of tax you owe. There are 5 filing statuses to choose from: single, married filing jointly, married filing separately, head of household, and qualifying widower with dependent child. Each has its specific criteria and tax implications. If you're unmarried, divorced, or legally separated according to your state law, and you don't qualify for any other filing status, you fall under the single status. If you're married, you can choose between married filing jointly and married filing separately. Filing jointly usually provides more in the way of tax benefits, but it's worth considering both options. If you're unmarried and pay more than half the cost of keeping up a home for yourself and a qualifying person, you may be eligible to file as head of household. It offers more favorable tax rates and a higher standard deduction than the single filing status. The qualifying widower with dependent child status applies if your spouse died within the last 2 years and you have a dependent child. It allows you to use joint return tax rates and the highest standard deduction amount. Remember, your marital status on the last day of the year determines your status for the entire year. And if more than one filing status applies to you, choose the one that gives you the lowest tax. Choosing the correct filing status can make a significant difference in your tax return. Finally, we're going to discuss the importance of understanding the timeline and avoiding common mistakes. Let's start with the timeline. In the United States, the tax year is from the 1st of January to the 31st of December. All the income you earn during this period is what you'll report on your tax return. Now here's the crucial part. You need to file your tax return by the 15th of April of the following year. If you miss this deadline, you could face penalties, interest charges, and even audits. So mark your calendars and set reminders. Procrastination is not your friend when it comes to taxes. Now, on to the common mistakes to avoid. One of the most prevalent ones is incorrect or incomplete information. This can range from misspelled names, wrong social security numbers, to incorrect income information. Remember, accuracy is paramount when filing your taxes. Another common mistake is not understanding tax deductions and credits. These can significantly reduce your tax bill, but they can be complex and vary from person to person. It's easy to overlook or misunderstand these, so it's crucial to educate yourself or seek professional help. Lastly, many people make the mistake of not filing a tax return at all because they think they didn't earn enough income. However, you may be leaving money on the table in the form of refunds or credits. It's always a good idea to file a tax return, even if you think you don't need to. In conclusion, understanding the timeline for filing taxes and avoiding these common mistakes can save you from a lot of headaches during tax season. Make sure you're informed, proactive, and accurate in your tax preparation and filing. This will not only save you from potential penalties and interest charges, but can also save you money by maximizing your deductions and credits. Understanding the timeline and avoiding these common mistakes can save you a lot of headaches during tax season. And there you have it, a guide to avoiding common tax return mistakes and their solutions. We've journeyed through the labyrinth of accurate income reporting, unlocking the secrets of maximizing deductions. We've explored the importance of choosing the correct filing status and understanding the timeline. Along the way, we've learned to sidestep the pitfalls that could lead to mistakes. Remember, navigating tax season doesn't have to be a headache. With a proactive approach, a thirst for knowledge, and a bit of guidance, you can sail smoothly through this annual obligation. So, arm yourself with these insights and turn tax season into a breeze rather than a storm. Thank you for watching. If you have any questions, feel free to comment below. And if you found this video helpful, don't forget to subscribe for more content like this. See you in the next video.